Good morning and welcome, Patriot Radio News Hour. I'm Joe Jaquint, CEO of the Patriot Trading Group, and welcome to Tuesday, 800-951-0592. That is our toll-free number. AllAmericanGold.com is the website, and I'm joined with my partner, Jason Walker, up there in Colorado. And Jason, I guess we got to talk hurricane. Heading to Florida right now. It's a Category 3. By this afternoon, it will be a Category 4. And it looks like it's got its eyes possibly set on Tampa. And you know what? It's something I did not know. I thought hurricanes, pretty common, obviously, in Florida, but not very common on the west side of Florida. And speaking of Tampa, if that's where this thing ends up, the last time Tampa got a direct hit from a hurricane was 100 years ago, over 100 years ago.
Oh, yeah, no, that's something you talked briefly about that with me this morning, but I didn't hear that specific fact. So you said 17 out of the last 120 have hit the west side. So I guess none of those 17 hit Tampa probably.
Yeah, that's and who knows? I'm sure there's some scientific explanation for it, but that's probably a good thing, I guess, for oil and the oil price and whatnot. Obviously, if it had gone farther west, you would have had refineries shutting down and things of that nature. But the Tampa area, probably not so good for the reinsurers. I'm sure there's going to be a lot of insurance claims coming out of that area.
That's right, Joe. That's right. We'll see. I mean, the insurance companies of the world, they look like they're going to be having trouble with a lot of issues. So if a massive hurricane goes smashing through Florida, that could cause a lot more economic stress.
Yeah, and then, again, eyes have to be everywhere. There was 3 explosions of the gas pipelines, the Nord Stream 1 and Nord Stream 2. These are the pipelines from Russia into Europe. The biggest one on the Nord Stream 1 pipeline, Jason, this thing actually registered on the seismic scale of between a 2 and a 3.0. There's almost no doubt this is not a run-of-the-mill leak. And there's 3 different leaks, if you will. A methane cloud now floating in the water. This is just so you know, this pipeline is in the ocean, so it's going through the ocean into Europe. Kind of very similar. Remember when in the Gulf when that one year that oil rig blew up and we had that oil slick? Well, this is a natural gas slick, and they're saying pretty much, Jason, this looks to be sabotage on these gas pipelines. It's got oil prices up, natural gas prices up. And just another one of these things that, you know, when you wake up every day, you just don't know. I mean, today at least, there's no currency collapsing, at least right now, but definitely some interesting developments heading into winter. No time frame for when this is going to be fixed, and again, a bad situation seemingly getting worse.
Yeah, that's right, Joe. It's Saturday will be October, so as you keep reporting these things, we'll see the direction we're headed. But once again, let's see what happens, right?
Yeah, and then when we get back, we're going to talk housing prices dropping rapidly. I'm actually going to, and as we get more information, the housing problem, you know, Jason and I, we may disagree on this one. I'm not sure, but I thought housing was going to be okay. You know, there was a lot of different factors. I'm starting to change my tune on this as yields continue to rise. Obviously, it takes a lot of home buyers out of the market, right? You're no longer, hey, I just can't afford a $300,000-$400,000 house. when I've got to have a mortgage of 7%. I just can't afford it. Then you factor in now the other big buyer out there, what I'll call the Wall Street banking firms. Listen, let's just say all in. Okay, after everything, right? They gotta have realtors. They gotta fix stuff up. They gotta pay taxes. They gotta replace roofs. They gotta replace hot water heaters. If they've got rental properties in Florida, they may have to get all this flood damage and pay the insurance and do all this stuff. Or do I just want to buy a 10-year note? 10-year note almost yielding 4%. By the end of the year, Jason, I think we're going to see a 10-year note above 5% and going to getting up to 6%, right? It just doesn't make that much sense anymore.
That's right, Joe. The way this thing ends up happening, how are things going to be priced? What's going to lose what value versus – it's all going to be what loses value versus other assets. Housing going down seems logical, Joe, because there's a lot against it. People aren't going to have money. People don't have the money to make payments or just to buy things. If you sell your house, do you have enough to get into the next one? So housing prices should go down, Joe. But how drastic will it drop versus other things? Because even though property isn't gold, Joe, it is an asset that has some value behind it. And I think in the end, anything that has substantial physical value is going to hold some sort of value, though. It's not going to crash all the way, not like the markets and Bitcoin.
When we get back, we're going to debate, because there's one key factor that will determine what happens to housing. I've got that coming up next. 800-951-0592. Gold and silver, basically. Whatever happened yesterday, unhappened today. Gold's up, $13, $14 here, $16.37. Silver up about 20 cents here, $18.60. The Dow is up a couple of hundred points. And just before we get back to housing, Jason talked about October. It appears OPEC is having a meeting on October the 5th. It looks like OPEC is going to cut oil production by up to 1 million barrels a day. And then remember, 2 weeks after that, the end of the strategic oil reserve, at least we're told that it's the end. Jason, we could have well over 2 million barrels of oil a day off the markets. OPEC is saying they want oil prices to be well above $90 a barrel. So just factor that in to everything else that we've been talking about. But housing. So we've got dynamics changing, right? First and foremost, affordability has changed drastically from January to today, right? We get that, right? You could get a 30-year fix at 3% in January. Right now, I think it's 6.8, something like that, right this second. 6.7, 6.8% on a 30-year fix. Got to remember, and that's 20% down and blah, 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 good credit, all that other stuff. So you're losing buyers there. The other, one of the other big buyers in the market is the investor. And I'm not talking about the guy that's, hey, I've got my main residence and I bought a rental property. I'm not talking about that guy. I'm talking about Wall Street. These guys that buy houses by the thousands. Listen, it made a lot of sense when the 10-year note, go back to January. Right? The 10-year note was yielding what? Half a basis point? Maybe 0.7%. Heck, why not go buy houses, rent them out, and make 5 or 6%? By the time after paying all the fees and this and that and blah blah blah, hey, we're gonna make 5, 6, 7%. Okay, well, that sure the heck beats 0.5%. Well, fast forward. Now all of a sudden, hey, we can make 4 or 5% and not have to do anything. And oh, by the way, the housing prices are starting to fall. The largest drop in history happened this morning with Case-Shiller. It fell about almost 2.7, 2.8% year over year. Now, a lot of you are like, well, that's not that much. That's true. But if it starts falling 2 or 3% a month, all of a sudden, are we looking at 30%? And again, I think the key is, and there's a couple of factors, cancellation rates, skyrocketing. Let me give you some numbers. Jacksonville, Florida, 26% of all homes that went under contract got canceled. Las Vegas, 23%. Atlanta, 22.6%. Orlando, 22%. Fort Lauderdale, 21.7%. Phoenix, 21.6%. Tampa, Fort Worth, San Antonio, Houston, all over 20% cancellation rates. But, Jason, here's the key factor. Price, okay? Price is going to fall. But is it going to collapse? I think that's really the argument here. Yeah, prices are going to fall. We're not sure exactly how much. I think we're going to have it fall a lot more than people think. But I think the big factor of whether it's crash or not, layoffs. Do the layoffs come? If the layoffs don't come, then I think we're going to have home prices are going to fall, but it's not going to be horrendous. If the layoffs come, Jason, that changes things because then these houses got to get sold, right? They go back to the bank. You could see a dramatic drop if layoffs come.
Yeah, and I see it coming down some, Joe. I guess I just don't see a massive housing crash like in 2008. There's two reasons. One, there was massive inflation in the 70s, but there was no, at least I wasn't really paying attention. Obviously, I was a kid. But I didn't hear of massive housing price crashes in the 70s because I think the inflation inherently eats up some of the value you lose, at least dollar for dollar. You're probably losing value, but dollar for dollar, you're not losing dollar value. And then the other thing is Janet Yellen mentioning in an interview that BlackRock, the companies like BlackRock that are swallowing up all the houses across the country should have too big to fail status. Why do I get the feeling that if BlackRock buys up all these houses at extraordinarily high prices, why are they paying $20,000, $40,000, $60,000 above asking price to scoop up these properties in the last year? You don't think they're that stupid, knowing that things could go the wrong way, unless they know something. So I wonder, Joe, that if BlackRock gets too big to fail, they're just going to scoop up all this property, knowing that, hey, it looks like a bad buy. It looks like there's going to be a property crash, but this inflation is going to go 4, 5, 6 years. This is a great buy. So that's what I'm wondering, Joe. Maybe we have a temporary setback in housing prices, but then it just becomes, can you afford to buy a house? No, go rent. That's what I'm wondering.
Yeah,
Joe.
I agree, absolutely. And I think BlackRock's not dumb. They'll buy at the bottom. They'll be the bottom feeders, whatever that bottom will be. I think, but that's going to be the key factor, right? How far does it fall? I think will depend on layoffs because the realities are we're probably about one rate hike away. So 5 weeks away from where that 10-year note would now yield about what these companies were making renting these properties out. And at that point, it no longer makes sense. Why deal with all the hassle when you don't have to hire anybody? You don't have to worry about taxes. You don't have to worry about, fixing water heaters or what have you or any of that stuff. When you just buy a treasury. You know what? Joey was on yesterday. And he said it, hey, listen, call me right now. The Treasury market's looking really good. It's a great place to hang out this morning. Jeff Gunlock says the same thing, says, hey, I'm starting to buy Treasuries right now. I think it's something that this is another one of these things where, hey, it's not a matter, it's just a dollar and cents thing. If I can get this much money, right, if I can get 5%, 6%, heaven forbid, more than that, without any hassle, why go through the whole process of buying homes? Unless, to your point, Jason, we know BlackRock has been building this war chest. Unless there's a huge price collapse, right? And then they come in and, a la try to recreate 2008. I'm not saying that it's going to be there. All I'm saying is all of a sudden it's going to be about layoffs, how bad housing gets.
And when you have more money, you can play a longer game, Joe. So let's just say the housing prices go down 25%, which that's huge. If they're going to continue to buy, which I think they will, they're price factoring it in. We bought it at this level, then it went down. We bought it at that level. Now it's going back up. The inflation is going to push a new built home to $550,000 or $650,000. And then if the inflation continues to go past 2023 and into 2024 and further, Joe, we would say somebody told us that, hey, Joe and Jason, inflation is going to be, let's just say 6% is a good number, but you may even see 9 or 10 or 11% in these numbers in the future. It's going to go on until 2026. If you knew that, then you're probably going to want to buy a house if you're in the market for a house now. You're not going to buy it in 2026, right, Joe? So that's what I'm wondering. I'm wondering if BlackRock knows the inflation.
Yeah, listen, it's a crappy time to be a buyer because here's the problem. If you don't buy now, rates keep going higher.
Yep.
So here's the problem. Even with the quote-unquote biggest drop in history on the Case-Shiller price index, you would have been better off buying a house in, obviously, January, February, March, April, May, June, July, just because the rise in interest payments is still making that payment greater than the price reduction that you're getting right now. And that's really the big problem.
Right, Joe. I mean, I bought my house in 2020 because as soon as coronavirus came ripping through us, I started seeing a lot of reasons why I was renting because that's what I needed to do in 2018. But I was like, you know what, I better do everything I can. I wanted to get into it because there's a lot of constitutional reasons I wanted to have it. But I got that lower rate, and the housing prices were lower. And I didn't expect housing prices to go crazy like they did. But I've got room now if things go down. And when you talked about treasuries, because if inflation keeps on going, housing could be a good long-term play. But you're right about treasuries. Robert Kiyosaki, he hates the Fed. He hates central banking. For the first time that I've ever heard him talk, he's buying into treasuries because he's like, well, I'm an investor. When I find things that are cheap, I buy things when they're depressed and lower. I don't buy things when the price has gone up because you lost all your profit. So yeah, Joe, if people are buying treasuries, that means the interest rates and the inflation might be going higher.
I'm going to give you Joey's number here really quick because you need to take care of that stuff. 602-909-9048. Something. It's weird. It's complicated. It just sucks right now. I mean, everybody is frozen. Everything is locked up. I don't know what's happening with the Dow right now. The Dow was up 200-300 points. It's now getting ready to go negative again. The interest rates just keep getting higher. Here, look at this 10-year note, 3.98. So getting ready to crest 4%. Italy, the 10-year note approaching 5%. The UK, listen, the UK 10-year note has lost its mind. It's been incredible now, over 4.5%. Jason, a week ago it was 3.5%.
Right. It's Joe, they're going to keep raising the rates. That's just the way it is. The inflation is here, and there's nobody that I'm seeing, even in the good fortune market news. The stock markets, they want it to be rosy and happy again. They want those rates to go down. They haven't gotten rid of the inflation and Joe, it just looks like the Fed really just wants this thing to just slowly grind into a bad spot. Why not just go up 2 points? Why not go up 3 points and really attack it?
Get it over with. Rip off the Band-Aid. Hey, bring the Fed's funds rates to 5% and get it over with. And you're right, because this thing becomes more and more entrenched here. And look, I'll use the UK as the example. They just can't help it. They're like, oh my, this is horrible. Look at these people. They can't heat their homes. They're gonna, and so let's give them money, right? Let's bail them out. Let's pay the power bills, and then all of a sudden, you know what? Let's throw a tax decrease on top of it, right? Let's just start spending money. All of these governments, they've turned into one big giant welfare system, and it's not just the UK. Every one of these governments, ours included, the second things get choppy, they want to start spending money again. And this is the problem. And this is why inflation keeps getting worse. The central bank is trying to take away the money. The governments keep adding to the money. Just broke today. The Biden welfare student loan debt thing. Oh, hey, you know what? Our math was a little off. It's not going to cost $300 billion. No, it's going to cost $400 billion. Whoops. Hey, but what's an extra $100 billion? We're just going to throw it on the debt.
Yeah, more freebies for a select group that they've chosen. I mean, how is it for somebody who has student loans? It's going to be really hard for them to vote against Biden in the next election, or the Democrats, if they're getting free money, right?
Yeah. The Dow just went negative. Like I said, I haven't seen any news to make that happen. But I'll keep watching. It's been a pretty quick turnaround here. Patriot Radio News Hour. Jason and I were coming right back. 800-951-0592. Patriot Radio News Hour. Joe and Jason. Right now, like I said, we've got gold and silver up. Wall Street was up. It's off, well off now. I don't know. I haven't seen any big breaking news. I just looked at the currency markets. The British pound is actually a little higher today. The euro's a little higher today. So it's not there. Obviously, the bond market yields just keep going higher. The ECB, this is the UK Central Bank. I'm sorry, not the ECB, but the UK Central Bank came out, Jason, and they just not good. Not what the markets wanted to hear, which has the UK bond yields rising even higher. But again, that was already in there, so I'm not sure exactly what has happened. But right now, you got gold up a dozen, 16.35. Silver's up about 25 cents here, 18.60. And the Dow right now is up 12 points right now. So we'll keep watching and to see how all of this plays out. But I think the big wild card now is going to be, as all of these rates continue to go higher, what are the effects in the economy? OPEC looking like they're getting ready to cut oil, so oil is going to remain elevated. Obviously, listen, oil's down, like $78, $79, $80 a barrel. But even with that, the lack of inventory builds leaves it very, very vulnerable. The key is going to be jobs, Chase. I think that's really going to be the key to everything. I'll say this. Let me tell you what I've noticed. My wife and I, we were at the supermarket Sunday. And the supermarket where we live, the deli, they have, the hot foods, and then where you get your sliced meats, your turkeys, your hams, your cheeses, and then they've got the pre-made stuff like the potato salad, the macaroni salad. You know what I'm talking about. It's huge. It has been unstaffed for months. Matter of fact, if they did staff it, it was like, hey, we're open till noon today, and it's closed. And hot foods, they hadn't made hot foods, I don't know when. Like, the rotisserie chicken, then they have you can buy like the chicken strips or the French fries. I mean, that hasn't been open forever. Not only, and we were in there, it was about almost 6 o'clock Sunday night. The deli counter was open. The hot food section was full of hot foods, all that stuff. So all these jobs that had been unfilled for months and months and months and months seems like they've been filled now, Jason. And I'm wondering Is this okay, are we going to start seeing this slowdown? It hasn't happened yet, but I think that's going to be the key.
So do you think there's going to be hot foods in that deli then, or no, then in the future?
Well, I think that, put it this way, these were jobs that they couldn't get filled. And I think people have had to get second jobs, third jobs. Maybe mom had to go back to work, whatever it may be, in order to pay their bills. And so all these jobs that were in demand, I think, have been filled now. And so I'm just saying it would appear to me that the job market is going to start softening and hot foods is going to be available. My point being, people aren't going to be, hey, I'm not doing that job. They're going to take any job they can get.
I agree with that logic. Definitely. I also wonder, Joe, if during the summertime they just don't have a high demand. You know, you got the parents going to work and the kids going to school. Then you run to the grocery store, and man, I just got the groceries for this week, but I don't feel like cooking, so you grab the hot food.
These things were always staffed. I mean, this was a big part of what they do, especially. But to see it. Like I said, it was pretty much closed for like a year. I mean, it wasn't
for a year. During school
and
and
it
off
was a
school.
long time, and I was shocked. I even commented to my wife. I'm like, "Holy cow, I can't believe it!" Right? I was so used to it just not being open. But again, maybe I just got lucky. Maybe they were only staffing it on the weekends. I don't know, but it was a change.
Right. Well, it's obvious that they're able to staff it now. The point is no matter what the situation, the point is they can staff it now, which they didn't do before. So that is a change, and those are the things that Joe and I look at around our normal day-to-day lives.
It sounds weird, right? Who cares about whether or not they got rotisserie chickens or not? But it matters. And not only did they have it staffed, there was 4 people back there. Because, like I said, I mean, this thing's massive. It goes on. It's I don't know, 60, 70 feet between the hot foods, the sliced, the deli meats. Then they have the potato salads, the macaroni salads. I mean, the sushi, all that stuff, and it was all staff.
There you go. Well, so you're right, Joe.
Who knows? Hey, just little things, right? It may not mean anything. But I think in the grand scheme of things, I think it really, really does mean quite a bit. So we'll have to continue to watch this. But again, housing now is something where I'm going to pay a lot of attention to. And here's the sad part. This is the sad part. You can take everything outside of the last, say, 2 weeks in housing and throw it away. Because we had another huge jump in the mortgage rates. 2-3 weeks ago, you could get a mortgage for under 6%. Now we're talking about mortgages maybe just under 7%. So we've had a whole point move in interest rates on a 30-year fixed in less than 30 days, and that's a huge effect on what people can afford, Jason.
And when's that next CPI number in October? What day is that coming out?
You know what? I will have that for you
in the next segment.
On the next segment, because that is key. Listen, that number is going to be really, really important.
Yep.
The last CPI number we got was not good. Way hotter than they wanted, and especially when they took away, well, we don't want to count this and we don't want to count that. What the number, that core number was really, really hot, and I think that's going to have a big impact on what we're going to see, which is when the next number comes out, which is going to be next month here. I'll give you the exact date. That is going to be critical. 800-951-0592. Patriot Radio News Hour. Joe and Jason here. Gold's climbing again here. 1639, 1640. Silver, 1860. The Dow, not much of a bounce here. Only up 50 points right now. We'll keep you posted there. CPI comes out on October 13th. The next Fed meeting, November 1st and 2nd. So this will be the only CPI report they get for the next meeting. And Jason, I think this will really determine, are we talking another 75 basis points or 50 basis points on this next CPI number?
Yeah, that's why I think if we get an 8.5 or higher, there's no way it's less than 75 basis points. I think if it gets above 8.5, like even gets, let's just say it gets to 9, it'll be a full point. That's what I think they'll do, Joe.
And the problem with the CPI, I'm just going to let you know now, rent. See, they don't track, they sometimes, you know what, they're their own worst enemy, right? They think they're so smart. They got rid of home prices and got rid of that. They actually got rid of rent too. And they went to this thing called rent equivalent. And what they like to do is call homeowners that don't have rentals. Okay, think about this. You're a homeowner, you get a call. And, hey, it's the Federal Reserve. Oh, hey, oh, yeah, hey, right? Usually if they call my phone, click, right? That's what I'm doing, click. But, hey, let me ask you this. What would you pay to rent out your house?
Yep.
That's how they come up with, just so people know, that's how they do it. Now, most people, right, especially if they're, hey, I don't really follow anything. I don't even watch the news. I sit on my iPhone. I watch TikTok videos, and I when I drive to work, I got the Bebop station on, right? I don't even pay attention. I'm absolutely clueless. They would probably say a number pretty close to what their mortgage payment is. Here's the thing, though. Even the people that are clueless have figured out, wait a minute, rents are crazy right now. And they keep saying, well, my mortgage is $2,000 a month. I get $4,000 for my house. And so the shelter part of the CPI, Jason, has been getting hotter and hotter and hotter, and it has such a big weight on it. It could be, to Jason's point, in theory, we would say, gosh, CPI should start coming down, but it keeps surprising to the upside, and it brings me back to a year ago. Because a year ago, remember, I was making fun of this CPI, saying, look at it, saying that shelter's only up 3%. Right, and we knew rents were up 30%, housing prices were up 30%, and they were saying 3%. Well, Jason, it's starting to catch up with them.
Right, and what I'm also looking at, Joe, is in the year over year for 2 years in a row, and I think that the reason I think that matters is because we're in that time frame last year, 2021, when the year over year was in the 5s for inflation. So it was bad, and the transitory and all that stuff. But when you started getting into October, November, December, it got into the 6s, then it got into the 7s, and then into the 8s. So if you have a CPI number coming into this next one, and especially the next one, where it stays in the 8s or even goes into the 9s, over a 6% number from the previous year, over a 7% from the previous year. If you keep if these numbers stay this high, Joe, on top of the previous year's highs, it shows a much deeper long-term problem. So if they don't get it in the 7s on this next number, Joe, they have to do 75 points at the low end, and if it looks bad, it'll be a full point. I'll guarantee it. It's going to happen.
So here you go. You've got a couple of different views, two guys. This is what we do for a living. I'm more pessimistic on housing. Jason is more pessimistic, right? He's not worried about missing to the low side. Jason's saying, hey, I think we're going to miss to the high side, and I'm thinking it's 50 basis points, and Jason's like, dude, it could be a whole point, and again, it just tells you this is a difficult time right now.
It all depends on the inflation number, Joe. All the Fed cares, the Fed is the power. No matter how much we like it or dislike it, they control what happens. And if inflation is not completely where it's supposed to be, or if it's where they want it to be, but they don't want it to get out of control. If they want it to be a slow burn, they have to do things to keep it within their control, and that means raising the rates, Joe. And if it doesn't drop, they have to raise it. They have to, and I don't think a half a point's going to do it if it's in the 8s. If it's in the 7s, I think Joe is right. It'll be a half point. But if it's in the mid 8s to almost 9, it could be a full point, Joe, easy.
Yeah, and that's something where, again, the timing of it, none of it's good. The biggest problem is we're starting to see central banks panicking. And really, not just central banks, governments. The most likely thing I see is the start of bank problems emerging from Europe. I just don't see any way out of it. The energy costs are so high. Now these pipelines just mysteriously exploding. The ability for people to be able to live is going to get very difficult. The banks trying to bail things out, or the government's trying to bail out people while the banks are trying to raise rates. It's a bad recipe, and the problem is which major bank is going to be the first one to buckle, because that sets off the chain reaction. And if we get that, that's when jobs start really going everywhere. That's what we got to watch out for. Patriot Radio News Hour, final segment coming up. 800-951-0592, $20 gold. And I'll get this online today. I should have done it yesterday. I apologize. $19.95. So same price as yesterday. Gold's up. The markets don't care. Once again, the paper, gold, and silver markets are completely irrelevant. Jason will tell you it's always disheartening every single day now. The wholesalers sending us, the dealers, we're buying. Now they're calling these special silver offers. What they're willing to pay for utility silver, junk silver, all-time record high pricing above spot. Tampa, by the way, looks like is going to take the brunt of this storm. Probably the third largest wholesaler in the United States is headquartered there. We've already got all of our stuff out of there. Brittany took care of that yesterday. The largest wholesaler in the world. They have offices everywhere, all over the world. But they're headquartered in Texas. And Jason, they're sending out emails, 3, 4, 5 emails a day. And it doesn't matter. They're buying old gold. They're buying utility silver. They're buying Morgan and Peace dollars. Anything they can get their hands on. And it seems like all as they do is every 3 or 4 days they raise how much they're willing to pay.
Yeah, I feel like I'm deleting 6, 7, 8 emails a day to keep up, because if I don't delete them, the next day is another 5 or 6 emails telling us what they're going to buy and at what price. So I got to keep it up to date, right? I got to get rid of the old prices because it's
just
constant.
Tells me don't be fooled here. So people are buying this like crazy. Obviously, in Europe, sales are off the charts because we look at it. We're frustrated where gold's at today because we've got the illusion of the strong dollar, but gold is just flying in the UK, in Europe, in Japan. And Jason, it's just a problem.
Well, and I think there's a lot of big players buying. The banks, the central banks are buying it. Countries are buying it, their governments. It's kind of like the housing thing, Joe. I do believe the housing prices will go down, but these big companies are just scooping it up, and it seems like a dumb thing to do when prices are going down, but it's hard. It's reverse thinking. You've got to buy stuff when it's down. So if gold is not at the price it should be at, then this is what we call the good old days. I got a record. I've been on with Patriot long enough to say I've got a record. In 2018 and early 19, Brian and myself, the afternoon show, we said that's the time to buy. It was $12.50 or $13.50 for a $20 Liberty. This was the good old days. Get it while you can. 4 years later, we're selling them on sale for $19.95. Now this is the next period of the good old days, because in 4 years, Joe, we're going to sell some of these for $4,000 or $5,000.
Yeah, that's the fear for sure. 9510592. The Dow it's negative. It's not a lot, down about 25 points here. We'll keep watching. Not a good sign. Lower lows. I think we're going to expect to see lower lows until there's a sign, Jason, that interest rates are going to stop rising. But right now, all indications are rates are going to keep going up, because now all of a sudden we've got the newest wrinkle, which is government starting to spend a lot more money at a time when inflation's already red hot. It's a bad cocktail, if you will,